Imagine waking up one morning to discover that the world's richest investors, the biggest banks, and even entire governments are panicking, not because the stock market crashed, but because something most people never think about suddenly stopped working. Trillions of dollars begin moving in every direction. Headlines explode. Companies freeze hiring. Mortgage rates jump overnight. And at the center of it all is something that most people have never bothered to understand: bonds. The strange part is that this invisible market is far bigger than the stock market. And if you don't understand bonds, you don't truly understand how money itself works. Most people believe stocks run the financial world. They watch stock prices on television, celebrate record highs, and fear market crashes. But behind every famous billionaire, every giant corporation, every central bank, and every government sits another market quietly pulling the strings. It rarely makes headlines until something goes terribly wrong. When it does, fortunes disappear almost overnight. The question is, why would a piece of paper promising future payments have the power to shake the entire global economy? To answer that, we need to travel back hundreds of years, long before smartphones, hedge funds, or billion-dollar tech companies existed. Picture a king preparing for war. Armies needed food, soldiers demanded pay, weapons had to be built. But the king's treasury was nearly empty. Raising taxes would take too long, and printing money wasn't an option. So he made a promise instead. Lend me money today and I'll pay you back later, with extra money as a reward. That simple promise became one of the most powerful financial inventions in history. But nobody could have imagined what that promise would eventually become. Over time, those promises evolved into bonds. Governments borrowed from citizens. Cities borrowed to build roads and bridges. Businesses borrowed to build factories and hire workers. Instead of selling ownership like stocks, they simply borrowed money. Investors loved the idea because they didn't have to gamble on unpredictable profits. They knew exactly how much they would receive and exactly when they would receive it. At least, that was the theory. Because hidden beneath this simple agreement was a force that would influence almost every financial decision on earth. Imagine lending your friend $100. He promises to return $105 next year. Sounds simple enough. That extra $5 is your reward for waiting. It's called interest. A bond works almost exactly the same way. You become the lender. The government or company becomes the borrower. They agree to pay you regular interest and return your original investment later. It seems almost boring, and that's exactly why so many people ignore it. But boredom has fooled investors before. As economies grew, something remarkable happened. Bonds became the foundation beneath everything else. Banks bought them. Pension funds depended on them. Insurance companies stored enormous portions of their wealth inside them. Even central banks used bonds to control inflation, employment, and economic growth. They became the financial system's heartbeat. You couldn't always hear it, but every beat mattered. And when that heartbeat became irregular, panic spread faster than anyone expected. Now imagine you're an investor choosing between two opportunities. One is a risky company whose future is uncertain. The other is a government bond backed by one of the largest economies in the world. Which one deserves your money? The answer changes constantly, and that's where everything becomes fascinating. Because bonds don't just compete with other bonds, they compete with every investment on earth. Stocks, real estate, startups, gold, even cash itself. But the real problem was only beginning. Here's where the story takes a dramatic turn. Bond prices and interest rates move in opposite directions. At first glance, that sounds confusing, but imagine buying a bond that pays 3% every year. Suddenly, new bonds begin offering 6%. Who wants your older bond paying only 3%? Almost nobody. To attract buyers, you must sell your bond for less than you originally paid. Suddenly, what felt like a safe investment loses value. Not because anyone stopped paying you, but because the world changed around it. This single relationship quietly influences billions of financial decisions every single day. Then enter the most powerful players of all, central banks. They don't simply watch the bond market, they shape it. During economic crises, they often buy enormous quantities of government bonds. This pushes bond prices higher and interest rates lower. Cheap borrowing encourages businesses to expand, families to buy homes, and investors to take more risks. Money begins flowing everywhere. Stock markets celebrate, housing prices soar, confidence returns. But hidden beneath that optimism lies a dangerous question. What happens when the medicine becomes the disease? For years, many countries experienced historically low interest rates. Borrowing became incredibly cheap. Governments borrowed, corporations borrowed, families borrowed, investors borrowed to buy even more investments. Debt piled higher and higher because everyone believed money would remain cheap forever. After all, why worry about tomorrow when today's payments seemed manageable? But history has a cruel habit of punishing certainty. Then inflation arrived. At first, it looked temporary. Prices rose a little, then more. Food became more expensive, energy costs exploded, rent climbed. Everyday necessities suddenly demanded more of every paycheck. Central banks faced an impossible choice: allow inflation to continue destroying purchasing power, or raise interest rates and risk slowing the economy. There was no painless option. And what happened next shocked financial markets around the world. Interest rates began climbing at the fastest pace in decades. Overnight, bonds paying tiny interest rates became deeply unattractive. Investors rushed to sell them. Bond prices collapsed. What many believed was the safest corner of finance suddenly experienced enormous losses. Institutions that rarely made headlines found themselves sitting on mountains of paper losses worth billions. Some could survive, others couldn't. One bank after another discovered an uncomfortable reality. They had filled their balance sheets with long-term government bonds when interest rates were extremely low. Those bonds weren't dangerous in the traditional sense. Governments were still making payments, but their market value had fallen dramatically. As long as nobody demanded their money back, everything looked manageable. But confidence is fragile, and banking depends almost entirely on confidence. When nervous customers began withdrawing deposits, banks suddenly needed cash. To get it, they had to sell those bonds at massive losses. Losses became fear. Fear became panic. Panic became bank runs. Institutions that had existed for generations suddenly found themselves fighting for survival in a matter of days. Millions watched in disbelief as financial giants stumbled because of something that most people had never even heard discussed at dinner tables. Nobody could have predicted how quickly confidence would evaporate. Meanwhile, governments faced another painful reality. Every time interest rates increased, borrowing became more expensive. Countries carrying enormous debts suddenly had to spend far more simply paying interest. Imagine using your paycheck not to improve your life, but merely to keep existing debts alive. That's the situation many governments began facing. Budget decisions became harder, political pressure intensified. Investors started asking uncomfortable questions about who could continue borrowing safely and who couldn't. Corporations weren't spared either. Companies that had expanded aggressively using cheap debt suddenly discovered that refinancing old loans now cost far more. Profits shrank, expansion plans disappeared, hiring slowed, layoffs followed. Businesses that looked unstoppable during years of easy money suddenly appeared vulnerable. The same bond market that had fueled explosive growth was now quietly applying the brakes. And then came ordinary families. Mortgage rates climbed, monthly payments increased. Buying a home became dramatically more expensive. Car loans cost more. Credit card interest rose. Student loans felt heavier. Even if someone had never purchased a bond in their life, the bond market had entered their living room without permission. It influenced their savings account, their retirement fund, their monthly bills, and even the price of the home they dreamed of buying. Suddenly, bonds no longer sounded boring, but perhaps the biggest misunderstanding remained hidden. Many people believed bonds were always safe. That's only partially true. Safety depends on what question you're asking. Will a financially strong government probably repay its debt? Usually, yes. But can the market value of that bond swing dramatically before maturity? Absolutely. Can inflation quietly destroy its purchasing power? Yes. Can rising interest rates erase years of gains? They certainly can. Safety isn't a single word, it's a collection of different risks wearing different disguises. Professional investors understand this better than almost anyone. That's why they obsess over the bond market every day. Before buying stocks, they study treasury yields. Before predicting recessions, they examine government debt. Before forecasting economic growth, they analyze interest rates. Because bonds often whisper warnings long before stock markets begin screaming. Those whispers have repeatedly changed financial history. Sometimes the bond market becomes so worried about the future that long-term interest rates actually fall below short-term rates. It sounds backwards. It shouldn't happen under normal conditions. Yet when it does, economists become intensely interested because history has shown that this strange signal often appears before recessions. It's as if the bond market quietly says something isn't right. Those paying attention start preparing. Those ignoring it often wonder later what they missed. The truth is, every dollar has a cost. That cost is interest, and bonds determine much of that cost. When interest is cheap, people dream bigger, businesses build faster, investors accept greater risks, governments spend more freely. But when interest becomes expensive, optimism collides with reality. Every financial decision suddenly becomes harder. The mood of an entire economy can shift without a single law being passed, all because the price of borrowing changed. Think about the world's greatest investors. Many spend enormous amounts of time studying bonds, even when the public is focused entirely on stocks. They know that stocks often tell stories about companies. Bonds tell stories about the economy itself. They reveal expectations about inflation, confidence, fear, and the future of money. Ignore those signals and you're trying to navigate a storm while refusing to look at the sky. Perhaps that's why so many financial disasters seem mysterious afterward. People search for one villain, one bad decision, one shocking headline. But underneath those events usually lies a deeper story about debt, borrowing costs, and confidence. Bonds rarely create excitement during good times, yet when confidence disappears, they suddenly become the most important assets in the world. The irony is almost unbelievable. The market that most people ignore may be the market influencing their financial lives more than any other. Every mortgage payment, every business loan, Every government budget, every pension fund, every interest rate, every major investment decision eventually connects back to bonds in one way or another. Once you notice those connections, you begin seeing money differently. Money isn't just paper. It isn't numbers inside a bank account. It's trust. A bond is nothing more than trust written into a contract. Trust that a borrower will repay. Trust that a currency will hold value. Trust that tomorrow will resemble today closely enough for promises to matter. When that trust grows stronger, economies flourish. When it weakens, fear spreads with astonishing speed. That's why understanding bonds isn't really about understanding fixed income or interest payments. It's about understanding the invisible language spoken by the entire financial system. Every rising yield, every falling bond price, every policy decision by a central bank is part of a conversation about confidence, risk, and the future. Most people never learn to hear it. They only notice the consequences after it's too late. The next time headlines announce rising mortgage rates, falling stock markets, government debt crises, or central bank decisions, remember that you're not watching separate stories. You're watching different chapters of the same one. Behind every boom stands borrowing. Behind every crash stands changing confidence. And behind both stands the bond market, quietly shaping the world while asking a simple question that determines the price of almost everything. How much is tomorrow worth today? Because once you understand bonds, you stop seeing money as pieces of paper or glowing numbers on a screen. You begin seeing promises, trust, time, and risk woven together into one extraordinary system. And once you understand that system, you realize something that changes the way you look at every investment, every economic headline, and every financial decision for the rest of your life. If you don't understand bonds, you don't just misunderstand one market, you misunderstand the very machinery that makes modern money possible.